Why does it sometimes seem like the richest people pay less in taxes than everyone else? You might have heard headlines about billionaires paying a lower tax rate than their own assistants. Is it just luck, or is there a method behind the numbers? The truth is, the wealthy have strategies, completely legal ones, that help them pay less in taxes, sometimes even less than someone earning an average salary. But how does it all actually work? Let's start by unlocking the key concept at the heart of this. Not all income is taxed the same way. Imagine you work a regular 9 to 5 job. Every month, part of your paycheck goes straight to taxes. This is called earned income, and in most countries, it's taxed at the highest rates. But what if, instead of earning your money, you let your money work for you? That's where things get interesting. One of the main ways the rich pay less in taxes is by making most of their money through investments, not salaries. When you buy stocks, real estate, or start a business, and those investments go up in value, you earn what's called a capital gain. Here's the twist. In many tax systems, capital gains are taxed at a much lower rate than regular income. For example, if you make $100,000 at your job, you might pay 30% in taxes. But if you made $100,000 by selling stocks you held for over a year, you might pay only 15% or even less. That difference adds up fast when you're dealing with millions or billions. But it's not just about lower rates. The rich have another powerful tool. They don't always have to sell their investments to use their wealth. Let's say you own $1 million in stocks. Instead of selling them and paying capital gains tax, you go to a bank and use your stocks as collateral to get a loan. Now you have cash to spend. But because loans aren't income, you don't pay any taxes on that money. This is sometimes called buy, borrow, die. Buy assets, borrow against them, and when you pass away, your heirs can inherit the assets, often with a reset in their value for tax purposes. So much of the tax is never paid at all. It sounds complicated, but let's break it down with a real-world example. Suppose Sarah is a tech founder. Her company's value has skyrocketed, but she takes a modest salary, just enough to cover her living expenses. Most of her wealth is in company shares. Instead of selling those shares and triggering a big tax bill, she goes to a lender, uses her shares as security, and borrows money at a low interest rate. She pays some interest, but it's much less than the taxes she'd pay if she sold her shares. Plus, sometimes that interest can even be deducted from her taxes. Another tool is the use of deductions and credits. The tax code is full of incentives for saving, investing, and even donating to charity. The rich often have teams of accountants and advisors who comb through the rules to find every possible deduction. For example, if someone donates millions to charity, not only do they support causes they care about, but they also get to reduce their taxable income. Or if they invest in certain types of businesses or real estate, they can write off expenses like depreciation, even if the value of the property is actually going up. You might also hear about offshore accounts or tax havens. While it's illegal to hide money from the government, it's not illegal to set up companies or trust funds in countries with low taxes, as long as you follow the reporting rules. Some wealthy individuals use these structures to legally reduce their taxes even further, though this is far less common than simply using the rules for capital gains and deductions. So, what can you, as someone just starting out on your financial journey, actually take from all this? First, understand the power of how money is made. If all your income comes from salary, you'll likely pay a higher tax rate than someone earning the same amount from investments. That's why building wealth through investing is such a powerful tool, not just for getting rich, but for keeping more of what you earn. You don't need to be a billionaire to start. Even small investments in index funds or ETFs can grow over time and be taxed more favorably than wages. If you have a side hustle or small business, learn about the deductions available. And if you donate to charity, keep track of those receipts. Those donations can reduce your taxes too. It's also important to recognize the psychology behind taxes. Many people feel frustrated seeing others pay less, but the truth is, the rules are public. The wealthy simply have more resources to understand and use those rules. But with knowledge, you can take advantage of many of these strategies at your own level. Start by building an emergency fund. Learn about the 50-30-20 rule to manage your spending and gradually shift some of your savings into long-term investments. Remember, the goal isn't to find loopholes or dodge your responsibilities, but to be smart, legal, and strategic. Think of taxes as a game with rules you can learn. If you start young, develop good financial habits, and take the time to understand how taxes work, you'll be in a much stronger position later, maybe even using some of the same strategies as the wealthy. To sum up, the rich pay less in taxes, not because they're cheating, but because they understand how different types of income are taxed, and they use investments, loans, deductions, and long-term planning to their advantage. The sooner you start learning these concepts, the more control you'll have over your financial future. So, take a page from their playbook. Invest for the long term, make your money work for you, and don't be afraid to learn the rules of the game. Because in the end, financial knowledge isn't just for the rich. It's for anyone who wants to build a brighter, freer future, starting today.